Right here on Smart Stock Sam, I told you Nio was building towards something big. And if you have been watching this channel, you already knew this moment was coming before the rest of the market even knew. Welcome back to Smart Stock Sam. And if you are new here, hit that subscribe button right now because this is exactly the kind of breakdown that separates serious investors from the crowd. Today we are covering one of the most compelling setups in the entire electric vehicle space right now. Nio just went through a sharp pullback, but beneath that red candle is a structural story that is stronger than ever, and I am going to walk you through our price targets for next week, the catalyst that could send this thing flying, and the exact entry zone where I think the smart money is quietly building positions. We are talking about an institutional accumulation story, a massive profitability inflection, a potential short squeeze, and a valuation gap so wide you might actually wonder when you see it. Buckle up, because this one is going to change how you look at Nio forever. Did you know that for the first time in its entire history, the company once nicknamed the Tesla of China has officially stopped burning through investor cash? While the rest of the market was panicking this week and retail traders were staring at red screens, something fundamental shifted inside this company. A structural pivot happened, and most people completely missed it. The cash burn narrative is dead. And today on Smart Stock Sam, we are going to break down exactly why Nio might be the single most undervalued play left in the electric vehicle sector. But before we get to the charts and the price targets, you need to understand the strategy shift that just de-risked this entire company overnight. And that shift starts with a rare moment of corporate honesty. Right now, Nio is sitting at a price of $4.87, but the internals are telling a completely different story. We are looking at a triple threat setup that almost never comes together this cleanly. A major strategy correction in Europe, a massive profitability inflection point, and a technical entry zone that looks like an absolute gift for patient investors. Institutional ownership has quietly crept up to nearly 48.6%. Let that sink in for a second. The smart money is owning nearly half the float, while retail investors are still debating whether this company will survive. And buried inside their most recent quarter is a hidden metric that changes the entire conversation, but we are going to get there. First, let's talk about what happened this week, because the story of the last 5 trading days is actually the clearest example of micro versus macro that I have seen in a long time. This week was a micro versus macro. It all started on Monday with a mechanical trigger that almost sent this stock into orbit. Nio hit an intraday high of $5.40, fueled by a staggering 177,627 daily battery swaps. That kind of demand surge created a wave of investor confidence almost immediately, which then triggered a massive flood of call option buying. Call options represented over 78% of the total volume that day. When that happens, market makers are forced to buy shares to hedge their own exposure, creating what we call a gamma squeeze that feeds on itself and accelerates. This validated our predicted breakout zone of $5 to $5.08 almost perfectly. And you know what? I am not surprised, because on this channel, we follow the data. But the momentum was not just built on hype. It was backed by a brutal admission from the executive suite. On Tuesday, Executive Vice President Mark Zhou did something that most EV leaders never have the courage to do. He admitted they were wrong. He called out what the team is now referring to internally as the Norway trap, openly acknowledging that Nio-S vehicles were simply too large for narrow European roads and that they had significantly underestimated the bureaucratic hurdles involved in that market expansion. This kind of strategic honesty is actually enormous when you understand what it signals. Instead of doubling down on a failing plan the way so many companies do, they redirected their Firefly sub-brand back to the domestic Chinese market. The result? They are already moving 6,000 units per month. They did not just admit a mistake, they fixed it. And that tells you everything you need to know about this management team. If that was not enough to build a solid floor of confidence, midweek brought the heavy hitters to the table. Nio secured a $330 million external funding round for its chip unit, Genetech. This is absolutely vital because it values that subsidiary at over $1 billion, while Nio retains a 62.7% controlling stake. That effectively de-risks their entire research and development spending in one move. On top of that, they signed a significant deal with Bosch for steer-by-wire and autonomous driving technology. When an engineering titan like Bosch chooses to partner with you, that is a global seal of approval on your hardware platform. At that point in the week, the bull case was looking virtually untouchable. Now, none of that matters if we do not talk about the black swan that crashed the party on Friday. Why did the stock drop over 4% in a single session? Two words: macro shocks. United States wholesale inflation, the Producer Price Index, came in at 2.9%, which was significantly higher than the expected 1.6%. That sent a shockwave through the entire market because it signals that interest rates may stay elevated for longer than investors had been hoping. Combine that with rising geopolitical fears, and you get a sector-wide sell everything event that has nothing to do with Nio specifically. The stock dropped to $4.87, but look closely at where it landed, right on its 50-day moving average. The price decoupled from the value, and that, my friends, is where opportunity is born. So if the price is down, but the company is getting structurally stronger, what is the actual value we are looking at here? This is the big payoff. Nio is projecting an adjusted operating profit of up to $172 million for the fourth quarter of 2025. Follow the trend line here. They have moved from the red into the green. They are no longer a startup trying to survive. They are becoming an incumbent starting to thrive. They are now targeting full-year profitability for 2026. This is the moment the entire narrative shifts from asking will they go bankrupt to asking how much money are they actually going to make. And the market has not priced that in yet. Now, let me ask you something that might sound crazy. Is there any chance that Nio builds an infrastructure moat so deep that Tesla itself cannot compete on the same terms in China? Well, consider this. Nio has officially surpassed 100 million cumulative battery swaps. They are planning another 1,000 new stations in 2026 alone. This is not just a convenience feature. This is a grid. It creates incredibly high switching costs for existing users. Once you are inside the Nio ecosystem, why would you ever leave? This physical infrastructure represents a barrier to entry that no competitor can replicate overnight, and it is being built right now while the stock is sitting under $5. And the biggest institutions in the world have clearly noticed something. D.E. Shaw and Company more than tripled their stake to 48 million shares. JPMorgan increased their position by 268%. BlackRock is up 153%. These are not meme stock traders. These are the largest and most sophisticated asset managers on the planet, front-running a profitability pivot that retail investors have not even begun to price in. They are buying the fear that everyone else is selling. But here is the part that might genuinely shock you. If we dig into the actual valuation models based on future cash flows, the fair value for Nio comes out to $18.27 per share, $18.27, against a current price of $4.87. Even the most conservative Wall Street analyst, Hold Rating, carries a high price target of $9.01. We are looking at a stock trading at a massive discount to its own fundamental reality. Could this gap close faster than anyone expects? What would it take for the market to finally wake up? Technically, the stock is sitting in what we call a coil. It is compressed between 50-day moving average support below and 200-day moving average resistance above. When a stock coils this tight, the eventual breakout tends to be explosive because of all the energy that has been building underneath the surface. The question is not if it breaks. The question is when. And that when could be triggered by a short squeeze. There are over 141 million shares currently short. At current trading volumes, it would take over 3 full days for those short positions to cover. If Nio reclaims the $5.15 level, it hits a gamma wall. Market makers who sold the $5 and $5.50 calls will be forced to buy millions of shares to hedge their exposure, creating a near vertical price move that short sellers simply cannot escape. Does that sound like the kind of setup you want to be on the wrong side of? Here is how we are playing it on Smart Stock Sam. Our buy zone sits right here between $4.85 and $4.90. This is the retest of the 50-day support. We are setting a hard stop loss at $4.73, which is our institutional floor, the zone where the big money has historically stepped in to absorb selling pressure. Our first target is the 200-day moving average, sitting at $5.24. Target 2 is the primary gamma wall at $5.53. This is an asymmetric opportunity, defined risk with outsized potential reward. Mark your calendar for March 10th. That is the fourth quarter earnings date where the profitability story will be officially confirmed in black and white for the entire world to see. Between the options expiration on March 6th and the earnings on the 10th, volatility is going to be intense. Manage your position accordingly and never risk more than you are prepared to lose. Before I give you my final verdict, I need to be straightforward with you, and this is important. Everything discussed on Smart Stock Sam is for educational and informational purposes only. I am not a licensed financial advisor. Nothing in this video should be taken as personalized investment advice. All investing involves risk, including the potential loss of principal. Always do your own research and consult with a qualified professional before making any investment decisions. Past setups and predictions are not guarantees of future performance. Now, with that said, here is where I stand. Nio has officially decoupled from its past. The cash burn story is over. The institutional accumulation is real. The infrastructure moat is growing. The profitability pivot is happening in real time, and the market has not caught up yet. My verdict? This is a strong buy on the pullback, and next week is shaping up to be one of the most important weeks this stock has seen in years. Do not let the macro noise drown out the fundamental music that is playing underneath. Now I want to hear from you. Here is my question for the comment section this week. If Nio hits full-year profitability in 2026 ahead of schedule, do you think the market finally re-rates this stock to reflect its real value? Or do you think the China discount keeps a lid on it no matter what the numbers say? Drop your take below. I read every single comment and I want to know where you stand. If this breakdown gave you a new way of looking at Nio, smash that like button right now because it genuinely helps more people find this content. And if you are not subscribed to Smart Stock Sam yet, what are you waiting for? Hit subscribe and turn on notifications so you never miss another setup like this one. I will see you in the next one.